Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Canada Goose's stock so we can determine if it's a buy or a sell. Canada Goose is a manufacturer of winter clothing. It markets a wide range of jackets, parkas, vests, hats, gloves, shells, and much more. It sells products wholesale and direct to customer with their own retail stores. The company is headquartered in Toronto, Ontario, Canada, and was founded in 1957. Let's get started with the model. This is a mid-cap company, 2.7 billion market cap. They're trading at $26 a share, and they have 105 million shares outstanding. We're going to look at the ticker that trades on the TSX, so all the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They didn't have any extra free cash flow in 2020, 260 million in 2021, then it dropped to 114 million in 2022, then it dropped even more to 50 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's cut in half from 150 million in 2020 to 70 million in the trailing 12 months. Revenue is the sales for the company, and that grows a little bit from 958 million to 1.1 billion. Let's look at the capital structure. 400 million of equity, 600 million of debt. They're 41% equity, 59% debt. Their net debt is 333 million. Net debt is debt minus the cash on the balance sheet. And they have a WACC of 10.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 3.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.1 billion. We divide that by 105 million shares. And we get a calculated stock price of $30. They're trading at $26, so they're trading at a 15% discount. It's a buy according to the model. Simply Wall Street values the company at $17. They're saying it's 55% overvalued, so they're in the opposite direction as me. 9 analysts priced this stock, and the average price target is 29. They're saying it's 13% undervalued. This is where the stock has been trading since they IPO'd in 2017. About 15 months after they IPO'd, the stock ran up a lot to almost $100 a share. Then the stock got really low at COVID, below their IPO price at about $20 a share. Then it ran up to $65 at the end of 2021. It has come back down quite a bit since then. So for the past year, it's been trading between $20 and $30. There are 21 companies in the same industry as Canada Goose. And Canada Goose ranks 10th in market cap of the 21 companies, 2.7 billion. The average is also 2.7 billion. The median is 1.7 billion. Their price to book is a lot worse than average. PE worse than average. Price to free cash flow worse than average. And price to sales a lot worse than average. So their ratios look pretty weak. So to summarize, I have them trading at a 15% discount. I ranked their free cash flows 4 out of 10, their revenue 6 out of 10, and their ratios 4 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.